This is everything you need to know as an investor about share buybacks.
So share buybacks are very, very interesting. People get excited. It's one of our 8 pillars. Of our 8 pillars, this is number 5. Is the company buying back their shares? Now, here's the deal, guys. As much as I like share buybacks, the very first thing you have to understand is the valuation of the business, because the company has cash, and that cash can be used to invest in so many different ways, including other businesses. Just because they're buying back their shares does not mean they should buy back their shares at any valuation. The first most important rule of share buybacks is you want the company to be buying back undervalued shares, right? Because they're deploying their capital in a smart way. They are being the investor. And even though they're buying their own shares back, you want to make sure they're buying their shares at a reasonable cost. If I had my own company publicly traded, I don't want to buy my shares at a high value. I want to buy them at a low value. Now, the second thing is, what does that do for you as an investor?
Tell me.
So, if a company makes $100 per year and they have 100 shares, Seth, how much does each shareholder get?
Well, I don't physically get this money, but I mean, I get $1 per share.
Right. And by the way, eventually you would see this $1. Let's say the company shut down tomorrow.
That's right. Like Twitter, for example, you were saying.
Yep. You'd see that. If the bank account's emptied, boom, sent to all the shareholders as a pro rata share.
That's right. All right, go on.
You pay down debt. You can do all these things with it. Now, let's say, hypothetically, this company is undervalued. So the company says, you know what? Our shares are, I don't care what they're selling for right now. It's irrelevant, but we're going to buy back shares. And a few years later, they go down to 80 shares. And guess what? The company's kind of boring. They still only make $100 per year. So what is now your share? If you kept your shares, what do you get now per share? You get $1.25. $100 divided by 80 shares.
Yeah.
So you still own your one share or whatever number of shares is, but now you get a bigger piece of the profit of the business. The company is rewarding you as a long-term investor for sticking with them. They're giving you a bigger piece of the pie. Now, to go back to valuation, let's say a reasonable valuation is 15 times earnings per share. In this situation, the first situation, the company's now stock price should be selling for about $15. $1 per share times 15 PE. Okay? So, the profit stayed the same. It went from 100, stayed at 100. But now you still have this 15 times multiple. Now what's each share price going to be worth? So now at $1.25 times 15, it is $18.75 per share. That is how you get growth in the price of the stock. Because if you remember, go look at all the analyst reports. When they report earnings, it's always at a per share. They'll do it on the normal number, but they'll also then say per share, that is this now. Because as you drive the per share price up, the PE could stay the same, but it still drives the price of the stock.
So theoretically, Paul, our price should be going up over time with a great company from 100 to something even better and making this even better, right?
So, great point. Now, let's say this company still grows, but it's just growing at a slower pace. So let's say this is 5 years later, and the company grew 3% per year. So after 5 years, let's make it simple and call it $115. Okay, what's 115 divided by 80, Seth?
$1.43.
Okay,
Wow.
So now
Come on.
their earnings per share jumped by 43%, even though their bottom line profit only went up 15%. That's the big key. Multiply this by 15, and what do you have here, Seth? What's $1.43 times 15?
$21.56.
Boom.
Come on.
That's how you drive the price of the stock, by buying back shares. Now, here's the hard part. And here's the part that everybody needs to understand when I accentuate buying a stock at a good price. Let's say this was some crazy company that was selling at 50 times earnings.
Tesla, 1,000 times earnings or something?
Whatever it is.
50 times.
You're like, oh, it's $50 a share. But in the future, everything comes back to normal. And now it's selling for, $15 a share. 15 times PE. That's how you lose money. Even when they're buying back shares at a terrible value. They're overpaying, and it's still going to hurt you. So what matters here is making sure that your company is buying back undervalued shares. Here's the way you really want to see it. The company's making making $1 per share. The PE is 8. It's selling for $8 a share, and they know over long periods of time it'll go to 15. That's how you get your big jumps. The company's buying back its undervalued shares. The PE is very low and shouldn't be that low. Because look, the growth is nothing. 3% a year, what a boring company. This isn't worth anything. Let's buy it. Let's sell it. Let's go for 8 PE. Then they buy back their shares, and finally people realize, wait, the earnings per share is growing quite nicely. Let's put a bigger multiple on this. Boom. That's how you make your money. This is the fundamental important part of share buybacks.
Okay, Paul, this is blowing my mind. Where can I find this information?
Okay, so let's take a company like Apple, for example. This is our Everything Money software, which I'm sure a lot of people have seen. If you haven't, watch our videos. They're all over. So on our software, you go to the income statement, and you go to the very bottom of the income statement, and right here you can see the buybacks. Now, it's not announced, but you'll see the shares outstanding at the end of each period. So back at the end of September 2012, Apple had 26.17 billion shares outstanding. As of the most recent, 16.7. That is almost 40% of their shares have been purchased back in the last 10 years. 40%. That's a huge number. That means if you owned 100 shares of Apple, it's essentially like owning, what is that number? 40%, 180 before, something like it. It's an insane number. That is what Apple is doing for you as an investor to reward you for sticking with them. And hopefully they're buying back shares at a good value.
I wouldn't think that Apple stockholders even know this is happening. If you're just mailing around, investing in good companies, you wouldn't even know you're being rewarded, wouldn't you think?
I think based on our community, what we've talked about with people being drawn to us, I think you're right. I think people, it's very overlooked. And that's why I call it the silent killer. Because the opposite is when they're issuing shares. And that's what they're doing. They're silently killing you by issuing more shares. Prime example is Twitter. Look at Twitter. Elon Musk just bought them. 10 years ago, they had 115 million shares outstanding. Now they have like 800 million. So that's how they kill people. By now, the opposite's happening. They're spreading their profit amongst more and more shareholders. So that's hurting you as an investor. But for Apple, they're rewarding their investors for sticking around. Now, I won't get into is Apple worth it, things like that. But companies will announce share buybacks, usually during earnings calls and things like that, right? And when do they start? They'll make the announcement in this quarter, in this fiscal year, we plan on buying X number of shares, dollar values back. We're going to spend $40 billion of our capital. Go look at the history of share buybacks with Apple. Carl Icahn was, I believe, the first to really push Apple and Tim Cook back in 2013 or 14 to start buying back shares of Apple. He sat there and said, listen, you guys got a ton of cash. You got to do something with it. Either pay a dividend or buy back shares. Now, the key with buying back shares is it's better for tax efficiency. If they pay out the dividend, they've already paid the taxes after when that money in the account. When they give you the dividend, you're paying taxes again. It is double taxation. Okay? So that double taxation hurts you. If they buy back shares, there's no extra tax. They're just giving you a bigger and bigger piece of the company. It's deferring the extra taxes for down the road, much further down the road. Share buybacks are a great way to build a lot of wealth in a very undervalued company. I recently bought Hewlett Packard in the last year or so. It just came out that Berkshire Hathaway took an 11.5% ownership stake in Hewlett Packard, and their big reason was share buybacks. They love the fact there's an undervalued company and the company was spending its cash to buy back shares.
If you're a new investor and you're drawn to these concepts, you can click right here, watch more of our videos, and learn more. See you next time.